What if I told you that the next big financial shock in America might not come from banks, interest rates, or government debt? It could come from crypto. Not some small correction, not a market hiccup. A full-scale collapse that wipes billions of dollars off the market and leaves ordinary people scrambling. And the scary part, almost no one is talking about it. Most people see crypto as a revolution, a way to bypass banks, to get rich fast, or to hedge against inflation. But beneath the hype, there are cracks. Deep structural cracks that could turn the entire system upside down. If you own crypto, invest in it, or even just think it's safe, you need to understand why this might happen, and why it could happen soon. Let's break it down. Why does this matter today? Because crypto isn't a niche anymore. In America, millions of people hold digital assets, from Bitcoin to Ethereum to newer tokens promising the moon. Even casual investors have exposure through retirement accounts, apps, or meme-driven hype. When crypto collapses, it won't just hurt a few speculators. It could destabilize tech markets, shake confidence in digital finance, and even spill over into traditional banking. And the signs are already there. The first core idea is leverage and margin. Many crypto investors don't just buy coins with cash. They borrow money to amplify gains, a practice called leverage. When prices rise, leverage magnifies profits. But when prices fall, losses are amplified the same way. During the last crypto crash, exchanges like FTX and others collapsed partly because people borrowed too much. The system created a domino effect. One major default caused panic withdrawals, which caused more defaults, which caused the platform itself to fail. Leverage hides risk when prices are rising. People feel confident. Everyone's making money. Social media reinforces the idea that you must invest now or miss out. But just like a thin layer of ice on a pond, it only takes one small crack to create chaos. The second core idea is liquidity risk. In traditional markets, large investors can usually sell assets without moving prices too much. In crypto, liquidity is far more fragile. During a crash, selling pressure can snowball. Prices drop, more people panic, more selling occurs. Some crypto tokens have tiny markets, meaning one large sell order can wipe out half the value instantly. This is compounded by stablecoins, coins that are supposed to hold a $1 value. If a stablecoin fails, it can create cascading panic. People start withdrawing en masse, and suddenly, billions in supposed safe assets evaporate. And the psychology behind it is simple. Humans panic when they feel everyone else is panicking. Loss aversion, the idea that losing hurts twice as much as gaining feels good, drives irrational selling. The third core idea is regulatory uncertainty. America has yet to define a clear framework for crypto. The SEC, the Treasury, the Federal Reserve, they are all involved, but rules are inconsistent. Some tokens might be classified as securities. Others are commodities. Certain exchanges might face sudden shutdowns or enforcement actions. This creates hidden systemic risk. Investors assume crypto operates outside traditional regulation. But when regulators step in, prices can drop instantly, confidence collapses, and leveraged positions unwind rapidly. People forget that regulation isn't always slow. A single announcement or court decision can trigger panic. And social media spreads it faster than any newswire. The fourth core idea is the concentration of power. Even though crypto is marketed as decentralized, in reality, a small number of whales hold massive portions of tokens. Large exchanges control huge amounts of trading volume. If a few big players move their holdings, it can shift markets dramatically. Small retail investors can't counteract that. This centralization risk undermines the decentralized promise and makes the market vulnerable to coordinated shocks or sudden liquidity squeezes. The fifth core idea is the herd mentality amplified by technology. Crypto thrives on hype. Social media platforms, Reddit, Twitter, TikTok, all amplify the fear of missing out effect. People buy because others are buying. They sell because others are selling. This isn't just speculation, it's a human behavioral pattern. We follow crowds, often ignoring fundamentals. In crypto, fundamentals are already murky. Many projects have little intrinsic value, and token prices often depend entirely on perception. The combination of leverage, liquidity fragility, regulatory uncertainty, concentrated power, and herd psychology creates a perfect storm. When these factors align, a collapse doesn't need a trigger from traditional markets. Even a minor news story, a technological glitch, or a regulatory hint could cascade into massive losses. Let's raise the intensity. Imagine a scenario in America where Bitcoin drops 40% in a week. Retail investors panic, exchanges halt withdrawals. Stablecoins begin to fail. Tech funds holding crypto-linked assets see their portfolios shrink dramatically. Margin calls force mass liquidations. Banks with exposure to crypto loans face defaults. Confidence erodes, and suddenly, the ripple affects not just crypto, but the broader financial ecosystem. The key insight here is that crypto doesn't exist in isolation. Its digital promise gives the illusion of independence, but in reality, it's deeply connected to traditional finance, human psychology, and technological infrastructure. Most people underestimate that connection because crypto feels abstract. It's not cash in your pocket, it's ones and zeros on a screen. That abstraction hides risk until it's too late. Another hidden pattern is the repeated failure to learn from history. We saw it in 2008 with mortgage-backed securities. People ignored leverage, moral hazard, and herd behavior. In 2022, the collapse of FTX showed similar dynamics. Yet, each new crypto boom repeats the same mistakes: excessive leverage, hype-driven investing, concentration of risk, and weak oversight. Behavioral science explains this. Humans discount future risk, overestimate their control, and follow social proof. In crypto, these tendencies are amplified by algorithms, notifications, and instant information flow. The psychology of bubbles is built into the platform itself. Finally, consider the global implications. If America experiences a crypto collapse, it won't just affect investors domestically. Tech markets worldwide are intertwined with American capital flows. International funds, blockchain-based projects, and even emerging economies with crypto exposure could see sudden shocks. This is not just a digital problem anymore. It's a potential systemic event. So what does this mean for you? It means understanding crypto isn't about whether it will rise or fall tomorrow. It's about recognizing structural fragility. Ask, how leveraged is the system? How dependent are prices on perception versus utility? How centralized is ownership? How quickly could a regulatory decision ripple through markets? Because bubbles don't announce themselves. They feel like opportunity. They feel normal. The greatest risk is not volatility itself, but the belief that risk has vanished. Crypto might feel revolutionary. It might feel unstoppable. But the same human behaviors, greed, herd mentality, overconfidence, and ignoring fragility, that created past collapses are alive in this market today. And until those behaviors are understood and mitigated, collapse remains not just possible, but likely. The lesson isn't to fear crypto blindly. It's to see the hidden patterns. To question assumptions. To understand that systems, not just individual actors, determine outcomes. Because in markets driven by psychology, technology, and power, ignoring structural risk is the fastest path from prosperity to disaster. And right now, those risks are growing quietly, while almost everyone remains convinced that crypto is untouchable. The question is simple: are you seeing the cracks before they become a chasm?